Pre-Market Prep. I'm Brianna Valesky here with Joel Elkann, and we're joined by Adam Sarhan. He is the founder and CEO of Sarhan Capital. Adam, thanks for coming on the show today. How are you doing this morning?
Wonderful. Thank you for having me.
Absolutely. Well, we have Alcoa reporting earnings tomorrow, which is the unofficial kickoff of earnings season. I would love to get your expectation for Q2 earnings. We've got a pretty interesting situation. I mean, we're looking at lower year-over-year energy prices, another strong dollar quarter, of course, the Greek crisis, high labor and commodity costs. What are you expecting out of some of these earnings reports?
So there's two things I'm looking for earnings. Number one, obviously, how did the company do with respect to the same quarter last year? This way you get you compare apples to apples. Were companies able on aggregate to put up good numbers, grow their sales, grow their earnings, or not? And if the answer is not, then clearly the question becomes why?
Mm-hmm.
And if there's not a clear answer to that, that bodes poorly for both Main Street and Wall Street. That's the first thing. The second thing, and more importantly, what I want to look at, well, it's a twofold part. Let's just say there's three things. And the second thing would be how companies react to the earnings. And then third thing would be guidance. The one big takeaway from last quarter from earnings season was guidance. If you noticed, the companies that got hit the hardest, Twitter, LinkedIn, Yelp, et cetera, et cetera, et cetera, they gapped down and got hit hard when they lowered guidance for the rest of this year.
Right.
So lots of times you see different variables. Investors focus on different variables each earnings season. And last earnings season, it was definitely guidance front and center. So if companies continue to come out and the share price either is adversely affected or it reacts positively, that's obviously the most important thing front and center for me. Secondarily, what were the actual numbers with respect to the same quarter last year? And then third thing, what happened with guidance? Those are the three key things from earnings season this year.
Okay, so let's take a look at some of the things that may or may not be affecting earnings season. Commodities and oil. We've got some moves in oil lately. What's your outlook for oil right now?
So in general, oil, it's important to keep in mind that oil is in a bear market. So my outlook by definition is down.
Right.
What we saw is oil is trading like a penny stock, and it is not a good sign for the stability of the global economy. This time last year, you rewind the clock, it fell, I think it was, exactly a year ago, oil was trading about $110 a barrel. Right now, we're at 52. What happened was, late last summer, early fall, you saw oil begin to fall and fall hard. It fell 60% in a few months' time. And then it tried to bottom in January, February, and March of this year, but you saw an oversold bounce from March to June, really end of April, early June. Oil rocketed about 45, almost 50% in a few weeks' time. So after falling 60%, oil jumped 45, 46%. It went from the March low to the June high, right around $60 a barrel. And it stayed there for about 7 or 8 weeks, 9 weeks. And it tried getting above 60. It couldn't. And then all of a sudden, a week and change ago, just a few days ago, you saw oil roll back over again, and it started falling hard right into the July 4th holiday, and that the selling continued yesterday and now today. So in the last 2 days, oil is down, I think, 11 or 12%. So you had to, let's just recap. You had to forget that it's oil, a major global commodity. You have an asset that fell 60% in a few months. It rallied almost 50 in a few weeks. And then it's now down 11% in about 3 trading days. If you didn't know what that asset class was, if we're on Jeopardy, name the asset class or any type of game show, you'd probably say, if you survey enough investors, it's a penny stock. And when you see these major global markets trading like this, it's not just oil. We can segue and talk about China or other asset classes as well. Other commodities are trading all over the map. So when you have a situation where these big markets are trading like penny stocks, that typically bodes poorly for the stability of both Main Street and Wall Street and the global marketplace in general.
That's a great point. It'll be interesting to see where oil prices continue to move throughout the rest of the year. I would love to shift focus and take a look at something that I haven't heard too many people talking about. China's stock market. I mean, it seems like everyone's can't stop focusing on Greece, but I mean, Bloomberg's over here saying that what's happening in China right now in their stock market is close to our Wall Street crash of 1929. I mean, brokerages are buying up tons of yuan. The central bank is effectively becoming the buyer of last resort. Can you kind of give our listeners your outlook on the situation over in China right now?
Yeah, absolutely. We put a special report out for our clients over the weekend, and it basically reiterated exactly that exact point. So what happens here, for months we've been saying careful, Chinese stocks are bubble territory. They're just going up too far, too fast. And we've been all over that as far as, hey, it doesn't make sense when you have IPOs coming out left and right and then going up several 100%
Right.
in a matter of days. And we saw that in the spring of this year, and we spoke about it, we wrote about it at length. And then what happens eventually, Brown, is that you get a situation in every bubble where mania takes over. It's not even euphoria. It's a stage that's past euphoria. Greenspan back in the 90s talked about irrational exuberance. So it's exuberant. It's way past that. When you get a manic phase where people almost get blinded by just get me in, no matter what the price is, no matter what the fundamentals are, and every type of logical decision-making process or component that should go into their decision is just factored out or removed from the equation, you get these bubble-type scenarios. And they happen time and time again throughout history. If you notice, one of our core principles in the way we invest and the way that we trade is that human nature is the one constant throughout history. And that's why we're able to do what we do. So in addition to fundamental and technical analysis, we coined the term psychological analysis because we believe that prices are driven a lot more by emotion, and it's very difficult to remove fear and grief from the decision-making process for most people. And that's why most people fall behind the queue, and they lag the market as far as returns, no matter what the market they're trading. So getting back to China, people were paying ridiculous prices, to use a nice, PG word or a G-rated word, for stocks that it was mindless. It was mindless activity.
Mm-hmm.
So eventually the bubble had to burst, and that's exactly what we've seen in the last few weeks. China's stock market's down about 30% in a few weeks' time, and it's in bear market territory. So it's still up for the year, but you had a massive, massive rally, and it was called the Beijing put. The Beijing government, China's government propped up stock prices, hoping that would help their economy. But the problem is they put too much fuel, and then it turned into a fire, and now everyone's rushing out, getting out of the way, and you have a mass exodus on the way out, and that's exactly what happens after bubbles burst.
Adam, we got to talk a little bit about Greece here, and I'm being primarily a technician, I do look at the fundamentals, but technically speaking, last Friday we had the gap down in the S&Ps, and we traded down 30, 40 handles. We came all the way back. You had the same scenario in yesterday's trading. You had the gap down and you struggled, but you came back. But you're not back to that close. I look at that close at 86 and a quarter basis the September contract. I see the resistance building here at the 2080 level. For me, in order for this bull market to keep going, I'm going to keep an eye on 2080, 2082 in the S&Ps. Can you really break it down, that simple, technically, or is there anything that's going on in the market right now? I know you've had a, long time bullish thesis. Is there anything here that's, giving you a little bit of a second thought?
Yeah, that's a great question. So there's two things. One, remove Greece from the equation and just look at the market.
Okay.
It's a very split tape. So for many, many years on your show, it was bullish and the market was going straight up. Everything was fine and dandy. Well, something's changed. Clearly, the ability for the market to fall and stay down for this amount of time is not the best sign in the world. That's the first thing. But really, more importantly, underneath the surface, if you step back and look at the major indices, there's two sides. There's the bullish side and there's the bearish side. Well, the bullish side said, even with all the selling, even with Greece, even with China, even with all the negative headlines you want to throw in there, the S&P 500 is only 3.5%, if not 3% below its all-time high. So it looks like the end of the world, but if you step back, it's in the middle of its long trading range going back the last 6-7 months. So by definition, the next move wins. And that's one of our trading rules, where we say, okay, we have clear lines in the sand on the upside and the downside. If support's broken in the S&P, you can go back and look at near-term support, you can use a 200-day moving average, which is we're right there, yesterday's low or last week's low. And then you can go back to 2039 would be in cash, not in futures, but you can go back to March's low and look there. So if in futures, if you want to use those terms, just take out March's low, you have a near-term, that's support. If that's broken and the 200-day moving average is broken, odds favor, we're going to get another leg lower. Now, if conversely the bulls are able to show up and defend support, which they've done every single time, almost marvelously, except for last October, but every other time the market's tried to pull back since June of 2012, it's been a shallow pullback in size and scope, meaning we haven't had a 10% correction in the S&P since, I believe, June of 2012. So it's 3 years. It's very long in the tooth. We haven't had a bear market since '09. So, or if you want to say 20%, a little in 11, but I would really say since the end of '09. So you're in a situation here where it's an aging bull market. Most bull markets ended shortly after their fifth anniversary over the last, few decades. Look at the 2002 low after the dot-com bubble burst. That ended in October of '07. That was right around 5 years. You can look at the in the 90s, right up to the 99, 2000 top, you had a 5-year bull market there. In the 80s, leading up 82 to 87. So you had these 5-year bull markets. We're now 6 years into this bull market, 6.5, but we're still there because there's easy money from the Fed and other central banks. So that's the underlying bullish fundamental backdrop that remains in place. But looking at the tape and taking out all the other variables, whether it's Greece or it's this or it's slowdown in the economy, it's earnings, what have you, it's a very, very split tape right now in the market here in the U.S. And we're seeing other stock markets begin to roll over. We mentioned China and some other ones as well. And if that selling spills over, eventually this bull market will end. Remember, every bull market in history has ended. So it's not a matter of if this bull market's going to end, it's when will this bull market end. So we're operating with the thesis that this is an aging bull. It still is a bull. And if the bulls are able to step up and curb the bearish pressure and send the S&P back up above, in your case, 2082, 2080, I like that level. You can look at the 50-day moving average would be the next line of resistance you want to see taken out. And then you want to look at the old chart highs near 2120 in the futures or 2134 in cash. So if you can get that bullish momentum to the upside, a deal gets done in Greece, enter the positive headline du jour, to me it doesn't matter, just what is the tape telling us. I like to say the market's speaking, are you listening? So if the market's able to get above resistance and get some legs here, boom, you could easily see new highs in a short amount of time. But conversely, if we break support, this long 6-7 month trading range, look on a monthly chart in the S&P, it's going to turn into a big top. And that's really what's happening right now. It's a very split tape, and the next move, by definition, wins.
Adam, I'm a little curious if you have any thoughts on what investors should be doing during, when they see like a financial crisis like in Greece or Puerto Rico can't pay its debt. I mean, are there any trading or investing moves that the average investor can be taking at this point to play this?
Yeah, that's a great question as well. If you're looking, it depends on your time frame. So there's 3 time frames that we look at. There's short term, there's intermediate term, and then there's long term. So if you're looking for swing trades or short term trades as far as buying and selling and things of that nature, I would look at stocks that focus most of their money is derived from the U.S. So look at individual stocks that make their money from the U.S. I was interviewed on radio yesterday at CBS in Chicago, and they had the same question, hey, how do you make money in an anti-Greece play? So the way that you make money off of an anti-Greece play is to look at companies that make most of their money here in the U.S. Or I said Facebook was a good way of playing it yesterday because of the fact that it's social media, and the other social media stocks are getting decimated. So look at the strongest one out there. Any type of social unrest or civil unrest, and you see millions of people in the streets, literally in the streets, they're online, and they're going on Twitter, they're going on Facebook, and they're going to be being social, for lack of a better word. The more people that use Facebook's platform, the better it is for Facebook to monetize that to their advertisers, which translates into more revenue and earnings growth for Facebook and their shareholders. So that's a good way. Another way is you look at companies that make most of the money. Look at something like a Netflix, for example. They're expanding overseas, but the bulk of their business is U.S. Goldman Sachs or the big banks, J.P. Morgan. If Greece leaves the Eurozone, Goldman Sachs and J.P. Morgan, a lot of these big banks are going to stand to do very, very well because they're going to charge exorbitant fees for helping Greece gracefully leave the Eurozone. Conversely, if Greece doesn't leave, the big investment banks are also standing to do very, very well because that should mean the economy will continue to grow. And if the economy grows, rates are at zero, these banks do very, very well.
Wow, that's a great point. The social media one has got me kind of reeling. I never thought about that. Yeah, when more people are on the streets, they want to share, they want to show what's going on, and so they're going to be using more social media outlets. Only have a couple minutes left with you here, Adam. How about we talk about just some individual stocks that have been kind of hot lately? What about Fitbit? Recent IPO, part of the fitness craze. I mean, health and wellness is a pretty profitable sector to be in. Oh, what are your thoughts, fundamental, technical, on the stock?
So the good news with Fitbit is that the stocks so far has acted very well right off the bat. And then the first day actually it came public, I was interviewed on TV, and I wasn't a fan of it because there was nothing proprietary about Fitbit. And I
Right.
said day one, careful buying it because I don't like buying these overhyped stocks. But in a few days' time, the game could change. And that was exactly at day one, the stock fell, and then a few days later, boom, the stock took off. So whenever you get in these overhyped IPOs, it's really, really important to step back and ask yourself, what is going on? Is it that manic type behavior of, hey, I need to get in and I don't care what price I'm paying? Or is there something longer term or something more to the story?
Hmm.
In Fitbit's case, the good news is their numbers are spectacular so far. If you look at the last 4 quarters, double-digit sales growth, triple-digit sales and earnings growth, you've got great fundamentals here. And most of these IPOs that have come out recently just don't have those.
Right.
So that's one reason Fitbit had a good run. So definitely from a fundamental standpoint, there's no question Fitbit's one of the best IPOs from a fundamental standpoint this year. My problem with Fitbit is that from a proprietary standpoint as a consumer, they had a great product 7 years ago when they launched. But right now, there's nothing that the Fitbit band can do that is proprietary. So in other words, Samsung, Apple, Amazon, Google, enter the big company you want, can come in there and blow them out of the water. The Apple Watch can do almost everything the Fitbit can do, except I believe there's one sleep function that the Fitbit can do where it monitors your sleep patterns that Apple Watch can't do just yet. But I believe there's an app coming out for that allow them to do that. So the real question becomes is that why would somebody walk out with and have a watch, have a Fitbit, and then have an Apple Watch? That's a little ridiculous. So maybe an Apple Watch instead of the Fitbit. The price, then the bullish side is say, well, to get a $60 Fitbit, it's a much lower price point. You can attract more people. That's fine, but I feel like it's smart money that invented this like 7 years ago. It was a great time, and now it's almost like they're selling out and cashing in because they know the Apple Watch literally didn't exist before last quarter. And
Yeah.
now that the competition's starting to come out there, and a lot more smart watches are coming out also, that's my problem with Fitbit long term.
I absolutely understand that. I mean, that's the same thing we talk about every time we bring up this stock. We're like, what can this do that other smartwatches can't do right now? So I'm glad you brought that up. We've been on the line with Adam Sarhan. He's the founder and CEO of Sarhan Capital. Adam, thank you so much for joining us this morning. We always love to talk to you about macro, micro, U.S., pretty much anything.
My pleasure. Thank you. Have a